Hello everyone, welcome to this episode of Your Life, Your Money. Markets have become very volatile. You have seen what's happening in the last couple of weeks. Markets are continuously drifting or showing signs of going nowhere. In these circumstances, how do you build your mutual fund portfolio? It's a major change in the economic landscape of the world. The earlier methods adopted by you may not work right now. The present situation, the volatility, the changes that are brewing in the world order necessitates for you to build mutual funds in a very scientific approach to make sure that it will perform under any conditions. In this episode, I'm going to talk to you a step-by-step approach for you to build the mutual fund for the volatile environment. Stay till the end of the video. Every word, every sentence that I speak in this video is something you should take note of and adopt in your journey of mutual fund investment. This is NRI Money Clinic for you, and I am Dr. Chandrakant Bhatt, your financial guide for a happy living.
NRI Money Clinic. No hype, just the right advice.
The world is changing. Make no mistake. The way the world was functioning earlier and the way the world is going to function from here onwards is going to be different. Will the dollar become expensive or the rupee becomes expensive? It cannot be predicted. Who could be the leader in the world? Whether it is going to be US, China, some other country or a group of country, that cannot be predicted. The United States is beset with a lot of problems. It has lots of debt. You have a president who is unpredictable. You have a team of advisors to the president of United States who are trying to do too many things too quickly. On the other side, China is not giving any scope for US to ride on it. It has kept its currency low for a long period of time in a very artificial way. It is ambitious. It wants to control the world. The world is going through a kind of a third world war. It may not be the war fought with two armies, but there are every indication to say that there is a power tussle which is happening in the world, and it is encompassing many countries. It's just not US, China. Now, as we see, UK is getting involved, Middle East is getting involved, India, China, Ukraine, Russia, in one or the other form, are also involved in this particular turmoil which is happening. If you want to know how the world is changing, I will suggest you one video by P Guru's channel. P Guru's channel is a very respectable channel from US, and I'll give a link to this video. If you have time and interest, you can check on the video to know what all the things which are happening and how it might impact the world going forward. All that I'm trying to say here is that world is becoming more and more unpredictable. Under these circumstances, the mutual fund investments will also change. The old methods of investing in mutual funds, as you have been practicing during the bull market, may not work from here onwards. So we need to be looking at how we can build the mutual fund portfolios for these changing circumstances. For the beginning, let's look at how people build their mutual fund portfolios or select schemes. There are three distinct inputs for people to select the mutual fund. Number one, either the Google ranking or Morningstar ranking or a CRISIL ranking or some ranking given by some agency. That is where you look at it. You look at how the fund has performed, and that's how you pick up the funds and you invest into it. When the markets become volatile, the ranking also varies. So you saw a great ranking in the past because it was a bull market. A spike in the market changes the long-term performance of a mutual fund as well. Likewise, when the funds are falling down, you go and check the ratings now. Again, it will change as per the falling market. So it changes on a daily basis, changes on a week by week basis, changes on a month by month basis, because the funds are falling down or funds are stagnating. They are consuming more time. Every time you look at a ranking, it will change. So it's not possible for you to select a fund based on the ranking which is given on Google or any other platform you are looking at it. The second way you look at a fund or select a fund is through the expense ratios. Look, expense ratios, in my personal opinion, is not something to be considered too seriously, at least in case of India. Why I am saying this? Because in case of India, expense ratio is not under the control of either the mutual fund houses or the advisors by us or anyone can dictate the expense ratio of a fund. The regulators have done a phenomenal job and they have controlled the expense ratios from time to time. They have given a matrix. If your fund size is so much, your expense ratio should be like this. So they have given the benefit of the size of the fund to the investors themselves. So expense ratio is not something of a differentiator for you to look at it. And let's say between fund A, B, C, D, the expense ratio may not be too high. There is, of course, a difference between a direct and a regular fund, but I'll come to that at a later point of time. Just remember, expense ratio cannot be a major thing which will dictate your choice of fund. It's not something like that one fund has 1.5% expense ratio, the other fund has got 4%. Then what you say makes sense. There could be a fund which is having an expense ratio of 1.5%. Some other fund could be having an expense ratio of 1.8%. The difference could be 0.2, 0.3. Not a significant difference in the expense ratios which will make an impact in the long run. So the expense ratio is out. The third thing is the news, the articles, opinion of the YouTubers, and the general place from where you pick up your news. Again, this will become useless for you. Why? Because no one knows how the future is going to unfold. So when they themselves do not know how the future is going to unfold, your decision based on what they say itself cannot be true. It can turn out to be true. It could turn out to the contrary as well. It's a fact that no one knows which side the world is going, how it will pan out. Will there be inflation? Will there be an interest rate hike? Will there be commodity cycles? What kind of a cycles it will follow? How will this tit for tat which is happening in the tariff, what's happening at this point of time, can shape the economic landscape of different countries? Nothing is known. When nothing is known, then how do you believe or how do you depend on the views you get on the television, newspapers or YouTubers or even from people like us? Let me admit, we also do not know how it's going to be. All that we know is that we have to keep your eyes and ears open. We should make reasonable judgment. We should position ourselves to see that unnecessarily you will not suffer, or you should be in a position to gain out of what's happening in the marketplace. That's all we can do. So the news is not dependable. Expense ratio is not a deciding factor, and the rankings will keep changing. So all the three things which you depended on today is not something which you can count upon. The performance of the mutual funds you may pick up are very dynamic. They are not static. They react to what's happening in the economy. They will not remain the same. For example, when the interest rate rise, they may behave in a particular way. Some funds behave in a particular way. Some funds may not react to that interest rates at all. For example, you pick up an ultra short fund, it may not be reacting to the interest rate. However, you pick up a long duration government bond funds, it may react positively or negatively when the interest rate changes. Likewise, if the inflation is there in the economy, funds will react to it. Funds will react when the currencies behave erratically. Let's say dollar rises or rupee rises. The funds will behave according to it. If a fund has more of an IT as its part of composition, might react positively when the dollar value rises because the earnings of these companies could rise. Likewise, a vice versa situation is also possible. Geopolitics can have a bearing on the functioning of some of the mutual funds. Commodity cycles can have a bearing on how the mutual funds will perform. Conditions in another country may have a bearing on how does the mutual fund that you own in your portfolio may perform. I'll tell you an example. If US gets into a recession, which is the most possible cause, make no mistake, Indian IT gets affected. When there is a recession in US, the earnings of IT companies in India will come down. It has nothing to do with what's happening in India. India is behaving normal way. But since the earnings of these companies are coming from US, a recession in the US can affect these particular funds, which are the technology funds or a fund which has an excessive exposure to the IT sector. That's possible. If the IT gets affected, the real estate may also get affected because Indian real estate also depends on people in the IT sector, particularly in metros like Bangalore, Hyderabad, Mumbai, all these places. In case if there is a downward trajectory or a recession in the US, Indian real estate may also find headwinds. So the performance of the mutual fund is not as simply as put by the Google. but it will react to a lot of things which are happening in the economics of the world. It's just not restricted to one single country. Today it's a global village, so therefore it can react in different ways for different situations. You may have a specific question in your mind. What is the fund manager doing? If all these things are happening, it's the responsibility of the fund manager to change the composition and make sure that the fund does not get affected because of these changes. Make no mistakes. Fund managers many a times cannot do anything for these changed circumstances. It is beyond their scope. Let's say you are invested in a small cap fund and small caps are taking a beating. You may think, can the fund manager change from a small cap and sell the small cap and go and buy the large cap? He cannot, because his mandate is customers' money should be put into the small caps. If the small cap is falling down, he can't do anything about it. Let's say there is a fund manager who is putting money in a long duration fund. His mandate is to put money only in the long duration funds. Because interest rate is rising or interest rate is falling, he cannot make any changes. Likewise, large cap fund. Through the bull market of last cycle, 3-4 years, you have seen the large cap did not participate like the mid cap and the small cap. Do you mean to say that the fund manager of the large cap did not know that had they been in a mid cap and large cap, their performance would have been better? They absolutely knew it, but they were governed by a mandate to invest only in large cap. So always remember, don't be under the impression that your fund managers can do something to change the situation. Fund managers are governed by rules, regulations, mandate, and they cannot violate that. So the responsibility of building the portfolio lies primarily with you if you are a do-it-yourself investor, or with your advisor in case if you are working with financial planners or advisors. So you cannot take out this particular fact when you build your mutual funds. Now let me help you here with an example. Let's take the case of sports. Sports like football, cricket, hockey. And how will they handle similar situation? Sports is all about two teams playing, and the conditions will change, strategies will change, strengths and weakness of teams will change, weather will change. In case of a football and hockey, the positions are similar. You have the forward players, you have the midfielders, you have a defender, and you are a goalie. Sometimes, if you are very strong, you may play with 5 frontline players and 3 in the midfield, 2 in the defending, and 1 goalkeeper. But if you think you need to change, you may play with 4 people in the front, 4 in the middle, 2 at the defender level, and 1. You can change the combination as you want. Why does the captain or a coach change it? Because they sense something needs to be done and they have to react to the situation in a particular way. Likewise, in case of cricket. Cricket is much more complex. In cricket, you have the batsman, you have got the all-rounders, you have got the spinners, you have got the pacers, the fast bowlers, you have the medium pacers. So you have a combination of 11 persons. And the teams will generally have 14, 15 players, and you play with 11 people, and you change the combination according to your strengths, according to the condition of the pitch, according to the weather. So you keep changing. This is exactly what you should be doing when you're building your mutual fund portfolio. You should not have an attachment to, oh, I made money in the small cap, that's why I should have only small cap. Oh, my large cap did not perform last time, so I should never invest in my large cap. No, I made money out of Reliance share, only Reliance I should buy. My Colgate shares never performed in the last time, therefore I should not buy the Colgate. You should be free flowing. You should be guided by the condition of the day, situation of the day. Your portfolio should be futuristic in nature, not guided by what happened in the past, or not guided by your past experience or affinity or developed for a fund or a stock. So now let us get into the steps of how do you build your mutual fund portfolio. To build your mutual fund portfolio, first thing you should know is how the future is going to play out. That's the first step. The answer to that is you do not know how the future is going to play out. If you're working with an advisor, does he know how the future is going to perform? Here again, the answer is mostly no. Even if I am your advisor, I cannot say how the future is going to play out. So you do not know how the future is going to play out. Your advisor do not know how the future is going to play out. But there is one advantage with an advisor. The advisor can make reasonable guesses. It doesn't mean that the guesses will become right, but he can make reasonable guesses. The guesses that he makes depends on his experience, his assessment of the situation, his interaction with different participants of the market, and his hands-on situation can make him probably position at a better place than a do-it-yourself investor. It's not an insult, or it is not looking down any DIY who is watching this episode. The problem with DIYs is it takes a long time for you to get grip of the situation. It really takes a long time. And market cycles are not something which will happen in 1 month, 2 months. It will take decades together for the cycles to play out. So most DIYs, what happens is that in the initial phase, they take a hit, and over a period of time, they may become very mature. You could decide yourself, should you be learning from your own mistake, or you can learn from others' mistake. If you are working with an experienced advisor who has been in the marketplace for longer periods of time, who has seen the market cycles over longer periods and seen a lot of similar conditions, probably it makes sense for you to work with such advisors. By the way, before I speak on how the portfolios have to be built out, let me also tell you one thing. In case if any of you are interested to build a mutual fund portfolio which is robust, which can withstand any kind of an eventuality that might pan out in future, you can make best use of services provided by us. I myself is an AMFI certified mutual fund distributor. We have team of experts in our team who can also help you build that mutual fund portfolio. If you have an intention to build your wealth with the help of mutual fund, you can reach out to us through the numbers that we are given in the description box below. We have also provided a link there. Click on the link, it takes you to the WhatsApp. Send us a message that you want to invest in mutual fund, and our team of experts are ever ready to help you at any point of time. Why delay? Send that message now. Now let us look at how do we build a mutual fund portfolio. I'll give you the broad contours. I cannot give you the specifics of how we go about it because it could change from person to person, but the overall structure would remain the same thing. I follow a method called the bucket strategy. A bucket strategy is you pick up funds in different buckets. There are 4 primary buckets in the bucket strategy. Number 1 is a conservative bucket. Number 2 is a hybrid bucket. Number 3 is an aggressive bucket. Number 4 is a contra bucket or a tactical bucket. So when you have these 4 buckets of funds, different types, you can probably manage any kind of a situation that might pan out in the economy or in your life. Let's look at these individual buckets a little bit more in detail. Number 1 is conservative bucket. A conservative bucket is something like a debt fund, or it could be a multi-asset fund, or a fund with extremely low equity. Depending on which fund is available, what might happen in a commodity cycle or an interest rate cycle, the conservative bucket should be designed. So conservative bucket is less volatile. You can depend on this at any point of time. It resembles something like a bank fixed deposit. It resembles like your emergency fund. You can count on it in case if you were to need money at any point of time. Maybe you have an emergency in your life, or maybe stock market, let's say, collapsed by 50% and you don't have any money to make best use of it. You can use the money which is there in conservative bucket to buy into the equity. So conservative buckets is a stability. It is a foundation. It is the most stable part of your portfolio. The second bucket is a hybrid bucket. Hybrid bucket by name mentions that in the funds there are different asset classes. You have equity in it, you have debt in it, you have gold in it, you have international equity in it, you have real estate in it. The hybrids are much more volatile than the conservatives, but they serve one purpose. Here, the maximum benefits are derived because the fund managers can change the composition in a hybrid funds according to the changing situation. 2 hybrid funds are not similar. Let's say you pick up multi-asset fund. The 2 multi-assets from 2 different fund houses may not be similar. If you pick up 2 balanced advantages fund from 2 different AMCs, they may not remain similar. The only commonality between them is the nomenclature. Each one, see for example, you have a White Oak multi-asset fund versus an ICICI Prudential multi-asset fund. The commonality is the word multi-asset, but their performance, the composition are quite different, and the purpose for which it should be used is also different. White Oak multi-asset fund behaves like a conservative bucket, whereas an ICICI multi-asset fund behaves like a more aggressive kind of an equity kind of a fund. So in hybrid bucket, choice of fund is extremely difficult to make, and here you need to be having real good knowledge of how the cycles will plan out and how the funds have to be picked up. But nevertheless, this behaves like the midfielders in a hockey match or a football match, and the fund managers can change the composition within the mandate that they have and make most of the conditions which will pan out in the market. One other advantage of a hybrid bucket is when the fund managers change the composition of the fund, it will not come under taxation. Many people believe that you have to change the funds from A to B. Remember one thing, when you switch funds, it amounts to selling. When you sell, you have to pay the capital gains tax. When you sell and when you pay capital gains tax, the amount which is available for you to reinvest comes down. Therefore, any strategy which will avoid this capital gains to the extent possible is always beneficial. So the hybrid bucket also becomes a very important composition in your mutual fund portfolio. The third bucket is the aggressive bucket. An aggressive bucket is something like the front fielders or somebody like an opening batsman, somebody like Virendra Sehwag who can go and hit sixes. So you need to be again very careful. What shall I put it in the aggressive bucket? What is the cycle doing right now? Is it a time for the large caps? Is it a time for the small caps? Is it a time for mid caps? Or if I have to combine, how do I combine this? Your aggressive bucket dictates how your funds are going to perform over longer periods of time. You load too much into an aggressive bucket, then the volatility in your portfolio will rise very drastically. Or you put only small caps and mid cap, and it may not withstand the test of times. So it's a very tricky situation, and it takes a lot of experience and a lot of common sense to build an aggressive portfolio in this particular bucket. The fourth bucket is called the contra bucket, or you can call it as a tactical bucket. A tactical is something which you use in a small quantity. It is for a specific situation. For example, we feel this particular sector is doing well. Let's say defense is doing well, our PSU is doing very well. So we will take small amounts in that tactical bucket. Or on the contrary, it could be a pure contra play. A contra play is something which is like a batsman who is out of touch now, but it's a quality and it will come back and it will shine again, and I will give certain exposure to that. So the contra funds are also equally important. More than the tactical play, we'll say the contra. I still remember I was interviewing one of the finest fund manager, Mr. Abhishek Singh. He told me one thing which had not struck me in my 30 years of journey through the stock market. He said, if your entire portfolio is performing at its peak, make no mistake, your portfolio is running on the highest risk. Your portfolio should always have something which is underperforming at that point of time. That's because when the cycle changes, what is underperforming will take over and what's performing will come down the cycle. Therefore, your portfolio must have something of a contra, which means it should not die, it should not go out of fashion, but it's just out of form today, but it's a matter of time, it will come to the forefront. We have done one video on the beauty of contra investing. Let me show you the thumbnail of that video, a detailed video we have done there. If you are interested to know what's contra investing, probably you can look at this particular video to get yourself an idea of how beautifully contra can work for you. Now the crucial question is, we spoke about the buckets, how much to go in individual bucket, which funds to choose from, how many funds you have to put it, should I have too many funds, how can I restrict the number of funds, how do I do it? That's a subject meant for only the financial advisors. That is where the artistic ability, the scientific approach followed by your financial advisor or the experience he has can dictate. Also, the individual situation, for example, if somebody comes to me with he's already retired, his risk-taking ability is very less. I might load a lot of money into the conservative buckets, a little lesser into the hybrids, a very small proportion in the aggressive. I may not take any contra or any tactical calls with such persons. Somebody is very young, I may change the composition according to the situation. So how do you build the funds depends on the situation of the day, also situation of the individual person, how it should be handled. One thing I would like to tell you, anybody who wants to use our services, we cannot give you direct funds because we are distributors. We need to be paid. Therefore, we can give you only regular funds. There is a cost difference between a direct and a regular funds. Many people come and they spend time with us and say, you don't give direct funds. Let's accept the situation. See, we are in this profession. We need to be paid. How do we get paid? We get paid by the difference between a direct and a regular fund. Many people go to different monitoring apps and think that they give direct funds. Understand one thing. Recently, somebody came to me and he was using one of the monitoring apps. When I looked at the costing, it was very shocking to me. He was buying direct funds, but the monitoring app was taking 5% of the profits. Let's look at a comparison between direct and regular. Direct and regular has a difference of 0.5% to 0.6, 0.7% difference might come. Now, let's say if the mutual funds are making 12% profit for you, and if the monitoring app takes 5% of the profit, how much does that work out to? That works out to again 0.5 to 0.6 to 0.7 depending on how much the markets will give you. It boils down to the same thing. And in the process, the monitoring apps will churn your portfolio to prove to you that they are doing the great thing. Remember, churning of your portfolio is definitely not in your best interest. The lesser the portfolio churn you do, it is beneficial. When you churn your portfolio, there is a capital gains tax outgo. Unless you book profits, probably the monitoring app may not take. I don't know. I'm just making a guess here, right? So even if you go through, for them also it's a business, or if they don't get from this, they might be taking in some other form or something else. So remember, there are no free lunches here, whether you take direct funds or regular funds. Elsewhere, somebody is making money in a method which you do not know. So you don't need to be worrying too much about it. Get the benefit of comfort of working with experienced financial planners. Build your mutual fund portfolios. At the same time, I would like to add a word of caution. You may have to wait for a longer period of time these days. Markets are going through a turmoil. Markets are going through a tectonic shift. The economic landscape is changing. It will make you wait. But nevertheless, this is a time for you to load units in your mutual fund portfolio. Give it the discipline it deserves. Give it the patience it deserves. If you wait for a couple of years, I'm very, very sure you are here to make tons of money. Be disciplined, be patient. So dear viewers, don't lose hope on mutual funds. I have given you the direction to follow from here onwards. If it helped you to understand what you need to be doing, do give me a thumbs up, do subscribe for the channel, do share this video with your near and dear one, friends and relatives, and on all the social media on which you are connected with. Thank you very much for watching this episode on NRI Money Clinic. I shall be back with you with yet another useful topic in yet another episode of Your Life, Your Money next Friday. Till then, stay safe. Jai Hind.
Press the bell icon for more details and subscribe our channel.